joint and byproducts. See, what we've been learning all this while was about how are costs accounted. How do they record these costs in the books of accounts? So the format was that of a cost card wherein the direct costs are all accounted. Then the indirect costs, how they are accounted. Either by assuming a way in which the overheads would be related to direct labor. So yesterday's class we have looked into. So that's how the overhead costs are also accounted, added. Fine. So the basic point here is cost statements account for all the costs which are incurred for a particular product or service. Ultimately, that is what they have to find out. One of the objectives of cost accounting is to determine what is the cost per unit. So one of the objectives is to determine what is the cost price per unit. Once the cost price per unit is understood, then add a profit margin, then decide what is the selling price per unit. So to know what is cost per unit, see, all the costs are not incurred for the product or service directly, because all the costs are not incurred only in production department. That also we have understood. There are two types of departments. One is the production department, the other one is service department. Production department takes care of producing the products, that is manufacturing the products or converting raw material into finished goods. So production departments. There's another department called as service department. What do? They render services to the production department so that the production work can be carried out. So when we see that the costs are not only incurred in production department, that we can find out the total production cost divided by number of units gives us cost price per unit. But they are also incurred in service department. So all service department costs ultimately have to be distributed to production departments. Okay. So if there is a repairs department, so repairs department first will accumulate the total amount of repair cost, then that will be charged to all the production departments, and in each production department find out the total cost and then divide by the number of units produced in the production department. So finally we get what is cost price per unit. Okay, if that is the concept, okay, let's get back to our topic. What is the topic? Joint and byproducts. So in the production process, see, every product cost has to be identified. That is what we are looking at. But in the process of manufacturing products, sometimes the initial phase of manufacturing, the initial production, whatever is carried out, that if it is the same process, and then the costs also are incurred as a combined cost. So that is, let's say that there are three products. So when three products are produced, let's say until a particular point of time, all of them pass through the same process. So instead of accounting or instead of incurring the cost separately for each product, all three products, the costs are incurred as a combined cost or a joint cost. Okay. So then they get separated. For example, let's say if there are three products, then they would get separated. So A, B, and C. After they get separated, so the point of separation here we call this as split off point. They get separated, split off. After they get separated, then some more cost will be required so that the final finished product can be produced. Right? So the costs which are incurred during this common process, we call them as joint costs. And the costs which are incurred after the split off point, after they get separated, if there is any cost which is incurred, that is after separation cost. So this is after separation cost or further processing cost. The point here is what about this joint cost? This is incurred for all of them together. See, after separation cost, individually each product, how much cost is incurred is separately understood. So we see that they can be accounted separately. But what about this one? This is a cost which is incurred for all the three products combinedly, joint cost. So we have to understand how would this joint cost be separated and allocated to A, B, and C. Okay. Um, that is what we are going to learn. The title says joint and byproducts. So what is the difference between joint products and byproducts? See, when the intention is to produce two or more products, then if all of them are have equal importance, the intention is to produce all of them, then we call them as joint products. Sometimes because of the production process, if there is some other product which is produced, if there is an output of some other product which comes out of this production process, we call that as byproduct. That doesn't have as much value as the main products or the joint products. It is just some value which is realized, some output which comes out of the production process that has a very little value. Okay, so that is the meaning of byproduct. Joint products are um, the main products which are produced, which have more or less the same value. All of them have equal importance, but byproduct is not intended to produce. Joint products are intended to produce. Byproducts is just the uh, result of the production process. It comes out of the production process. Okay, so it has very less value. Even when it is sold, it has very less value, and it is usually sold for less value. The treatment is just like a scrap treatment. I will explain to you what is scrap treatment. I know that you have not learned about what is the treatment of scrap. I will also talk about that. So joint products are two or more products separated in the course of processing, each having sufficiently high saleable value to merit recognition as a main product. What are byproducts? Byproducts are outputs of some value produced incidentally in manufacturing something else. Okay, that is the main product. So it is not intended to produce. So that is the difference between byproducts and joint products. So if a numerical question is addressed, so the numerical question would be about how are these joint costs incurred? The joint costs are how are these joint costs allocated, separated? Separation, there are various methods, either depending on the number of units which are produced, depending on the market value of these units which are produced, whatever is the selling price, the sale value, that can be basis. So like that, there are various ways in which the joint cost is allocated between the joint products and the byproducts. So here what we have to understand is what are joint products. Joint products are those products which are intended to produce. They are the main products. They have relatively very high value as compared to the byproduct. Byproduct is the result of the production process, but it was not intended. There was no intention to produce that product, and the value of byproducts is relatively much lesser than the main product. If time permits, I will take up one question. Otherwise, let's see if we can work out one question now. Now that we have addressed this particular thing. Okay, done. Question number 245. We will take it up and work it out. I'll put this in the Excel sheet and then we'll solve this one. Let's work out this one. Char will operates a continuous process producing 3 products and 1 byproduct. Products 1, 2, 3, 4. Fourth one is a byproduct. The selling prices for all the 4 products is given. Then units of output from process is mentioned. The total joint cost is 277,000. What was the unit cost valuation for product 3 using the sales revenue basis for allocating joint costs, assuming that the revenues receivable from byproduct is a deduction? 245. Total cost incurred is the total joint cost. The total joint cost which is incurred is 277,000. So this has to be a portion allocated to the products. So here when the cost is allocated, it would be allocated only to main products. That is 1, 2 and 3. But what about the byproduct? So byproduct treatment is something else. We will see that. What is the basis of apportionment? The unit cost valuation for product 3 using the sales revenue basis. So let's first find out what is the sales revenue. Take that amount and consider that to be as the basis of apportionment or the ratio in which the costs are incurred. Okay, let's start. So sales revenue is what we have to find out. I hope you are able to see the Excel sheet on the screen.
Yes, ma'am.
So there are the products are we see 1, 2, 3 and 4. 4 happens to be a byproduct. What's the basis of apportionment? It says sales revenue. But sales revenue, first we have selling price. Selling price is 80, 25, 20 and 2. Then we see number of units of output. This is 10,000. Then we see 20,000. Again 20,000. Then 3,500. So find out what is sales. So here what we have to understand is, see, they have intended to produce 1, 2, and 3, but accidentally or because of the production process that there was something else also which had come out of the process, which is product number 4, which is a byproduct. Done. They did not intended to produce that, nor they are counting on uh, realizing the revenue or selling that product and realizing that revenue, but some value which is realized. So that is the treatment of scrap. Scrap is, see, the total cost is incurred. Then what do? We adjust the any amount which is realized by selling scrap. As simple as, see, when you sell major things, that will be sales revenues. Let's say at home also, see, there is some things like old newspapers, old magazines, and all. When you sell that, that is not a main source of revenue. Main source of revenue, something else. Suppose, let's say that's a business. So in a business, the shop, what are the main products which are sold? The whatever is the product, whatever they are dealing with, so that's their revenue. Let's say that in that shop, if there are old newspapers or old magazines and all, if they sell that, can we account that for as a revenue, source of revenue or sales value? No, that is also sold, but that is not accounted as sales. So what is that? So all the cost which is incurred, as against that, that is adjusted. So that is some minimum value which is realized. So byproduct sale also is the same treatment. That's how it is treated. So here what we see is, when they have incurred the joint cost, how much joint cost did they incur? Total joint cost incurred is 277,000. Out of that, see, the total cost will be reduced by the amount of 7,000. So less sale of byproduct, which is 7,000. So what's the total cost, joint cost to be apportioned? We have just 270,000. So this 270,000 has to be apportioned to the main products, 3 main products. So how would they be apportioned? So the (180) is to 500 is to 400. So that is the ratio. So 18 is to 50 is to 40. In this ratio, it would be allocated. The total part of it is equal to, total is 108,000. So let's write joint cost allocated. What's the ratio? The ratio is, in the ratio of 18 is to 50 is to 40. In this ratio, the joint cost will be allocated. The total cost is 270,000 into 18 divided by 108. So these are the joint costs which are allocated. Now the question is asking us to find out unit cost. So cost per unit. How do we calculate cost per unit? Total cost divided by number of units. So total cost is the joint cost which is allocated is 45,000 divided by the number of units are 10,000. Similar fashion for all the other two products also. So for which product are they asking? Product number 3. 3 is 5. These are the values. For product number 1, it is 4.5. Product number 2, it is 6.25. Product number 3, it is 5. So these are the unit cost per product. I hope you understood. So let's get back to the PPT and then continue with that. So after joint and byproducts, the next topic what we have is service and operation costing. See, businesses are involved in either selling products or rendering services. So they are businesses which do not sell products, but they are into providing services to customers. Okay. So what we have to understand here is what is the nature of such a business which renders services. See, in case of products, we see that there are products which are available. So we can see that, feel that, touch that, and then that is provided. But in case of services which are provided, we do not find anything like, see, service industry, like a hotel industry is there. So hotel industry is providing accommodation facility. So do they hand over anything to them? Does it have a physical form? No. They are allowed to use the service of the accommodation which is provided. So what is the nature of such businesses? How are the costs accounted is what we have to look into. In case of products, there is some physical appearance there, which is sold, that is transferred to the customers, as against which amount is collected from them. So we see that that is the nature of the transaction, wherein a physical form of an item is transferred, the ownership right gets transferred to the customer. The product is handed over to the customer, as against which the customer pays some amount. As soon as the sale transaction takes place, the ownership rights are also transferred to the customer. So that is what we understand. But in case of service rendering businesses, those who are into providing services to the customers, what are the main features is what we have to first understand. So if they are into providing services, let's say there is a transport company. Okay, then they are taking the passengers from one place to another place. So that is a service which is provided. They are taking them from one place to another place, as against which they are collecting some service charges or service revenue. So first we need to have a clarity about what are the main differences between a service business and manufacturing business. The ones which are into manufacturing the product, physical product, and selling those physical products. How is it different from the business which is into rendering services to the customer? So that point we have to first understand that. Output from service industries is different from product of manufacturing. See, these are the features. I tell you, you have to remember this till you finish your APM paper. Now, PM paper, APM paper. APM paper, definitely they will stress upon this part of it. What are the main points of difference uh, between the service industries, service businesses, and manufacturing industries or businesses? Okay. The first feature is heterogeneity. Second one is intangibility. Third, simultaneous production and consumption. Fourth one, perishability. Heterogeneity. Do you understand the meaning of heterogeneity? Someone please tell me what is heterogeneity? What is homogeneity? What is heterogeneity? Any one of you? Do you know the meaning? Yes, no, no also is an answer. You can tell me so that I'll explain that to you. Homogeneous, homogeneity. Okay. Assuming you are not aware of what the meaning is. Homogeneity is similar, identical. That's the meaning of it. Okay. Heterogeneity is not identical. It is different, different from one situation to another situation. So that is different. It is not identical. It is not the same. It is not similar. It is different. Heterogeneity. Homogeneity is it is identical. See, when the products are manufactured, the entire lot of units are identical. See, when they are produced, they're produced in a whole lot of them, and all of them are identical. These products are sold to the customers, so they are not different. But in case of service businesses, all of them will have the same thing is not a necessity. It mostly depends on whatever is the requirement of the customers. Okay. So let's say that if there is a transport business, see, if it is a, let's say for example, if it is a bus facility provided in to carry the passengers from one main main starting point from the terminal to another destination terminal, but in between there are many stages. So if some of them want to get down at different stages, that is allowed. It is not a compulsion that all of them will have to board at the starting terminal and then get down at the destination terminal. That is not a compulsion. Depending on whatever is the requirement for the customers, the clients, the customers, then such kind of services are provided wherein they are allowed to travel from one distance to another distance, one location to another location. It is different from for each type of customer. There is no such thing that it is the standard format which is available. They have to avail that. If hotel facility is there, hotel service, hotel industry is there. See, the hotel industry, when the accommodation is provided, not all of them they start on a particular date and end on a particular date. The time duration is the same for everyone. It has the same set of features and services which are provided. That's not a necessity. Okay, there are various customers taking the accommodation facility for different time periods, and they can expect different services which to be included. Maybe food is also delivered. Some of them do not want food, they only want a resting place, so they take the accommodation. Some of them are there for many days. Some of them are there only for one day or half a day or one period of time during the day. So anything it could be like that. So we see that when service business is um, started, the services which are provided to the customers are not all the services are identical. Mostly we see that the services are heterogeneous. Heterogeneity is there. So depending on the requirement of the customers, the customization part of it is taken into consideration. So that's heterogeneity. Okay. Intangibility. The second one, intangibility. What is intangibility? What is tangible? Tangible is something which can be seen, which can be touched, felt. All that is there in case of tangibility, like the phone in your hand or laptop in your hand, the book, the pen. So whatever you have it in your hands are all tangible. You can see them. There is a physical form of the product. Tangibility is one point in manufacturing businesses. They manufacture tangible products. They convert the raw material into finished goods, which is tangible, which can be seen, which has a physical form. That physical form is sold to the customers. But in case of service business, the service is rendered, which is intangible in nature. There is no physical form of that. See, if the customer is allowed to travel from one location to another location, see, it's the service which is provided. He doesn't get anything to carry with him in a tangible form. He only gets the service which is provided. That is, they carry him from one place to another place by way of that transportation mode. So the second important feature here is about the tangibility or intangibility. Manufacturing businesses have tangible products. Service businesses have intangible services which are provided. Third one. See, in case of manufacturing businesses, the manufacturing first takes place. The final finished product is available, that is kept available in the showrooms for the customers to come, or some place the customer comes and purchases later on. It is not that first he purchases, then the manufacturing happens. No, it is first manufactured and that is delivered to the customer for sale. So when sale takes place, the physical form, the tangible form of the product is delivered to the customer. So that is when the transaction is completed. Then the sale takes place. But in case of service businesses, the production of the service and the delivery of the service or the consumption of the service, both of them take place at the same time. See, if an accommodation is provided, it's not that accommodation is provided and the the client comes and later on takes it. No, when the facility of accommodation is provided, at the same time the client also consumes it. If there is a bus running from one location to another location, if the customer wants to avail that service, so the service is provided by the seller, by the service provider to the customer. Both of them take place at the same time, simultaneous production and consumption. Why are we calling it as simultaneous production and consumption? Let's say, let's say, if it is not consumed, if the product is not purchased by the customer in the period in which it is produced, what can they do? They can carry it to the next period. If in January they produced, customer did not buy in January, they can carry it to February. February it would be sold. But in case of services, if today the accommodation facility is not consumed, can it be carried forward to the next day? The unused vacant accommodation, can it be carried forward to next day, tomorrow's date, and the service which is available for tomorrow plus the balance which is brought down from the previous date? Is that possibility? No. If it is not consumed simultaneously, it perishes. If the accommodation is not utilized by the customer, in such situation, we see that if the accommodation is not utilized by the customer, then it perishes. It cannot be carried forward to the next day. But all tangible units which are not sold during a period, they can be carried forward to the next period as the ending inventory, the closing inventory. This closing inventory can be sold in the next period and sales revenue can be generated. So that is the concept of perishability. So we see there are four major points of difference: heterogeneity, intangibility, simultaneous production and consumption. If it is not consumed when it is produced, when it is available, it is not consumed, it would perish. It cannot be carried forward to the next period. So these are the four main points of difference. These are the four main points of difference under service businesses versus the manufacturing business. So now the concept of how do we account for that. Okay, based on their relevance to the service provided, may be necessary to use composite cost unit, more than one type of cost unit. So here the examples are given. What are the service industries? We see that hotel industry, transport, education, college, business, hospitals, these are all into rendering services to their customers. So in this case, for each type of business, each type of service provider, the unit is a different measurement. In case of manufacturing, the unit is number of units of that particular product. The physical count of those product units is taken. Hotel is not selling the number of units of a product, but rather it is providing accommodation to the clients or the customers. So the possible cost unit could be cost per guest per night. So for one day, one night, 24 hours, or whatever is that. So what is the cost of one individual guest for one night? Okay. If it is transport, cost per passenger per mile. Cost of uh, transporting one passenger for 1 mile, what is cost per unit? College or education, what is cost per student? Hospital, cost per patient or cost per procedure. So we see that more than one type of cost unit is available. The total cost which is incurred by these service industries are all um, accumulated, totaled it up, and then divide by the number of guests who are present. The so this cost is adjusted among the number of guests for the number of nights. Cost per guest per night, or cost per passenger, the number of passengers who travel for X number of distance, X number of miles. So cost per passenger mile, cost per student, cost per patient, or cost per procedure. So that's how the unit measurement differs from business to business. How to account for the cost? Service cost analysis. There's direct material, direct labor, direct expenses, then overhead cost. Add them up. All the costs are added together as total cost. After the total cost, just divided by whatever is the base. That is, we've seen various types of cost, unit cost. So total cost for providing service divided by number of service units used to provide the service. Okay. Am I audible? Am I audible?
Yes,
Yes,
ma'am.
Yes, ma'am.
No response, so I got it out.
yes,
See,
ma'am.
generally, the regular practice of accounting overheads, I have mentioned that overheads are not accounted as the actual amount incurred, because each item has to be divided and distributed. So that is not a possibility. So what is done? This is calculated as a percentage of labor. Yesterday in one of the questions we've seen that overhead cost is calculated as a percentage of direct labor. So that is the normal practice which happens. But there is a possibility of something else also which can happen. That is, overheads are calculated based on prime cost or labor or some material cost. Anything else also can be taken. But the most commonly used method of charging overheads is based on what is the direct labor. So, depending on situation to situation, we have how overheads are calculated. Because it's a time-taking process of dividing and distributing the overheads, they generally take it as a predetermined overhead rate. So, assuming some relationship existing between overheads and labor, once it is determined once, henceforth for every period, they would continue with the same overhead rate or percentage, and then account it in that particular fashion. But otherwise, it's a accumulation of all the costs, accumulation of the total cost, Total cost divided by the number of units of services which are provided. That gives us what is cost per unit of service provided. Nothing different about, nothing special about that. It is just basically adding up all these things and then dividing by the number of units. So if time permits, we can do it one question, but otherwise this is the explanation. But please remember what are the points of difference between manufacturing businesses and service businesses. You can also be asked to explain about or write about what are the points of difference between the service and manufacturing industries. The next chapter is chapter 11. This is chapter 11 is alternative costing principles. Under alternative costing principles, first one we have activity based costing, then we have target costing, then we have product life cycle costing, TQM. Okay, in your syllabus these things are there. The same set of topics will repeat in PM, same set of topics will repeat in APM also. So here what we do is we only learn the theoretical aspects of about these different we call them as advanced costing techniques, alternative costing principles, modern costing techniques which are available. Not only these, some more are also there. So you will be learning about those things also, like throughput accounting, etc. There are some other accounting techniques also which are available, which you will learn. But the basic introduction concept of what is these things, you will learn it now. See, right from the beginning, when cost card explanation is given, right from then I'm explaining one important point that, see, when costs are accounted, the first set of costs which are accounted are direct costs. Until prime cost, there is no issue because these are all variable in nature per unit. Identifiability is there. Calculation, identifying with each product or each service. It is easy to know that. What is the direct material cost, direct labor cost, direct expenses. Identifiability is there, therefore calculation is also easy. So until prime cost, there is no problem. Then comes the next part of it is the overheads. Overheads which are incurred at factory, overheads which are incurred at administration level, at selling and distribution level. There are many items of overheads. So as many number of items are there, the calculation has to take place for that many number of items. But for convenience sake, the traditional costing system does not take up the dividing and distribution of each type of cost according to the item of cost. For example, if we have repairs, we have maintenance, if we have stores department, canteen services, welfare charges, heating, lighting, material movement, assembly of the parts, inspection. See, there are so many examples we can put. So what has to be done? Individually, each of them have to be divided and distributed, but that they are not doing so. What are they doing? They have just one item called as production overheads. So take the production overheads as a base on either direct labor or something else. So some rate is taken. They calculate the amount and charge it to the cost statement. Will it be precisely the correct amount? No, it is based on some assumption. So it's an assumed value. It is not exactly as to what is the amount which is incurred. That is not the exact cost. It is an estimated, a calculated cost. Calculations based on some predetermined assumptions. Because in so and so year, in 1 year in the past, there was a relationship between overheads and direct labor in this particular fashion, that is as a percentage of something. The same thing is adopted year after year and it is taken, but in that list some of them may not be identified with labor at all. Let's say if it is machine repairs and we are dividing them based on direct labor cost, does it make any sense? See, machine repairs is not connected to direct labor cost. Machine repairs is a different item, direct labor cost is a different item. So, but then we do not make any such distinction as to what is labor cost, what is machine cost, but rather we go about adding up all the items of factory overhead and um, calculate the overhead amount and account it in the cost sheet. So that will result in the cost can be more than what actually is incurred. So we call that as over absorption, or the cost can be less than what is incurred, which is called as under absorption. So the method of calculating overheads can result in charging more cost than what is incurred or charging less cost than what is incurred. We see that it is not the correct amount of cost which is actually incurred, but rather because they're depending on a predetermined overhead rate, some predetermined overhead percentage, there is a situation that the overhead cost could be charged more than what is incurred, what they have actually spent, or less than what they have actually spent. So that can put them into problems. See, how do we decide what is selling price? Selling price is equal to cost price plus profit. Cost price plus profit. While accounting for the cost, if the costs are more, if they are higher, then we see that the selling price is also definitely it will also be higher. If the cost to price which is incurred or the costs accounted are less, selling price also will be less because selling price is equal to cost price plus profit. So both of them result in a disadvantage. Why disadvantage? Selling price is high, is a attractive thing. They will be able to get more amount of revenue. But see, when the selling price is higher, there is a danger that the customers can get attracted to the competitors' products. So they can buy competitors' products rather than buying the products of this particular product or business. They the demand will fall if the price is high. When the demand falls, they will not be able to sell many number of units. So in that case, that is a loss there. If price rises, demand falls. Demand falls, income falls. So it can also be a not profitable or loss situation. Then in that case, if the selling price is less, will that be an advantage? In that case also, it will not be an advantage because they're just charging less cost. That may not be the actual cost which is incurred. So the revenue which is generated, the sales which is realized will not even be sufficient enough to recover the actual cost incurred. So either ways we see that it is a disadvantage to business. But for convenience sake, the traditional costing system assumes a predetermined overhead rate, calculates all these three overheads, that is production, administration, selling and distribution, and ascertains what is the total cost, then decide what's the selling price. But both these methods have disadvantages. That is, if the selling price is high, demand falls. If the selling price is low, it may not be even sufficient enough to recover the total cost. So for that reason, there is a costing system um, which talks which addresses this particular limitation, and which says that instead of depending on predetermined overhead rates, first identify what are the activities for which the costs are incurred. Activities like repairs, activities like inspection, assembly, power supply, like that first activity should be identified. So for this particular activity, let's say repair, every time repair cost is incurred, all repair costs during a particular period are accumulated, pooled up together. So pooled up in a cost pool. The heading would be repair cost. So every time repair cost is required to be incurred or incurred, it is accounted under that heading repairs. So every repair cost gets accumulated, added up under a repairs cost pool. If it is inspection, if they take up inspection um, 5 times, so 5 different times the cost of inspection is accumulated or it is pooled up. So after accumulating that, then the total activity cost now should be charged to the products. If it has to be distributed to the products, then there should be a cost driver. What is cost driver? A basis of apportionment. Just now in joint costing, we have taken sales value as the basis of apportionment, isn't it? Because the revenue generated is taken as the base. But here, for the cost, we have to take a basis of apportionment. Basis of apportionment, or basically, we can also call it as usage of that cost. If it is repair, the number of repairs which were required by each product. So take that as the basis of apportionment, divide and distribute. So exactly whatever is the usage, to that extent costs are charged. Okay. Then after that, find out what is cost per unit. So if activity based costing is adopted, there will be no assumed values, but there will be actual values. What is the total actual cost? What is the basis of apportionment? A suitable, appropriate basis of apportionment. If it is inspection, number of inspections carried out. If it is power, number of units of power consumed by each product. So based on the usage, the actual usage, the costs are charged. These costs are the most appropriate, accurate, precisely accounted for cost. So the cost price is an exact or a genuine one. Deciding the selling price will also be appropriate, because that is the best thing what will be charged. It is neither overcharged nor undercharged that it will result in overpricing or underpricing. Okay, that limitation can be addressed when ABC is adopted. Don't have to be worried. We will not work out questions, because this theoretically just understand that. At least today I will not make you do a question, but we will take up a question if we have any more time available with us, assuming time should be available, but still we have many more topics to address. So on that note, if time is available, one basic question I will make you do about what is ABC, because ABC is studied as a full length chapter, a topic under PM as well as under APM. So the numerical questions, those things are also tested under PM and APM. So here, if time permits, we will work out one question. Today is fifth day, isn't it? We have 10 days of classes. 10 classes are there, 20 hours of training. Today is fifth day. So we have another 5 days. After I finish the syllabus, if time, based on the time, either one or two questions we will work out from ABC. First, let's understand the concept once again. when overhead costs, ABC is followed only in case of overheads, because direct costs, they are identified, directly identified, identifiability is there. So no problem with direct cost. The problem is with overhead cost, because the identifiability is lacking. They cannot be identified. Therefore, they have to be charged to the products. Traditional costing charges these overheads based on some predetermined overhead base, usually taken to be as labor cost, but some other things also are adopted as the basis of apportionment. That was resulting in either overpricing or underpricing of the um, products. That was resulting in decrease in demand or not being able to recover the total cost. So there are disadvantages under ABC. To address this, ABC principles, activity based costing principles, suggest that overhead costs should be charged to the products based on the usage. So, what is the procedure? There are steps in that. First, identify all the activities. Second, pool up all the costs which are incurred for that particular activity. Then, identify a cost driver. Then, allocate the cost to the products based on the cost driver. Based on the usage, the cost should be allocated. Okay. So these are the steps, and the right amount of cost is charged. So the right selling price can be decided, and it will be profitable for the business, but it will not be, and it will not be a loss to the business. Any clear? Any doubt about it? Is that fine?
Yes, sir.
The next one, the next topic is target costing. Target costing. See, just we've discussed about how selling price is decided. This is what we know how the selling price is decided is cost price. Find out what is cost price per unit. Add a profit margin. Decide what is the selling price. So that is the regular way of deciding the selling price. But in certain situations, in some types of products and markets, the competition is very severe. Many sellers are present in the market, then they compete against each other. So any seller which has uh, the price at a higher price than the others, the customers start dropping from that seller. They stop buying from that seller. They buy products of other sellers, because everybody is more or less selling the same type of product, and many products are available, many sellers are present. So they are homogeneous products which are similar to each other. So in that case, will the seller um, buy it from will the customer, sorry, will the customer buy it from a seller who's offering a higher price? If we were to be in that particular position, would we do that? See, when we visit a exhibition or something like that, wherein suppose one type of product is sold, we see all the stalls one next to the other. Do we walk into any particular stall and then pick up a product and then just buy it directly? We wouldn't do so, because there are many sellers selling the uh, product which are similar to each other. We would rather first walk into one or two stores, find out what is the price, what is the prevailing price, choose the seller, and then whoever is offering at a lesser price, we take it from them. Wouldn't we? We would do the same thing. So that is a regular practice. That's a regular practice of buying pattern which we see with the buyers. Buyers, they do not buy any product unless and until they are convinced that the quality, the features are different from others. Then only they become loyal to that particular seller. But otherwise, the option is open with the buyer to choose from various sellers present in the market. There are many selling the same type of product. So the criteria there is about who sells the product at a cheaper price. So in such markets wherein the competition is severe, we call that to be as a perfect market where there are many sellers present. In that case, the prevailing selling price, if let's say 20 rupees is the price of that particular product. If 20 rupees is the price, more or less everybody is selling it at 20 rupees. So in that case, every seller would think of selling it at 20 only. If the seller makes a mistake of charging 21, buyers will not be willing to buy it at 21, but they find another seller who provides it at 20. Okay, so such situations, it is not possible to apply this equation of cost price plus profit. So they do not take the liberty of first spending the cost and then deciding the selling price. If they spend more, if they spend excess cost, selling price also will be high. Selling price is high, they lost their customers or demand. So that is a serious thing. So in such cases, in such markets, the practice of deciding on the selling prices, they don't work out on anything, but rather they take the selling price which is prevailing in the market. So we also call this as market driven selling price. From the market, the selling price is picked up. Whatever is the price at which the other competitors are selling, the same price is taken. Now they would have a desire or expected profit. So that profit is deducted, selling price minus profit. We have this as cost price. That's the equation. Then this becomes the target. This cost price becomes the target. So they have this target and they spend now all the costs which are within this limit. Let's say when your parents are going out to some relative's place and you have to stay in the house for, let's say, 2 to 3 days. They hand over you some money and they say that, see that, ensure that you spend only within this amount. So what do? You're very cautious, you're very careful of not overspending it. If you overspend more than what you have, then you will be left with no money. So that is a dangerous situation. So what would you do? You are very, very cautious about how you spend that, because there is a target, there is a budgeted amount. So you ensure that your spending is within that limit. So also now the business has a target now. The target is this cost price, which is arrived at by deducting the profit margin from the selling price. So they have to ensure that they cut down all their costs, or they should spend in such a way that their actual cost is equal to this targeted cost price. Okay. If suppose if your parents say that you spend this amount, if you need, we will give you more. Would the child be with the kid be cautious about not spending more? He will spend anything because the assurance is there that anything what he spends, it will be funded. It will be given by the parents. Some additional arrangements will be made. So there is no effort which is put in by the child to cut down on any cost. In case if any selling price works out in the market, will the seller be cautious to cut down on the cost? No, because any selling price will be accepted in the market. So no effort will be put in to cut down on the cost. But because the market is competitive, because it is a perfect market, there are many sellers present. So they cannot make a mistake of deciding on a higher selling price. So now when they work out, this is the target cost. They have to take measures to ensure that their cost is within this limit. If they make a mistake of overspending in that, can they decide on increasing the selling price? It's not possible. So what is the price which they have to bear? Their profit will decrease. So target costing talks about cost control because their actual cost should match with the target cost. So the focus point here is about cost control. Says that a target cost is a product cost estimate derived by subtracting a desired profit margin. Profit is deducted from the selling price. By subtracting a desired profit margin from a competitive market price, the price is taken from the market, competitive market price. This may be less than the planned initial product cost. Initially, if they were given a chance to spend as much as that, so they will spend as much as they feel is the right amount. So that would be spent, but will be expected to be achieved by the time the product reaches the mature production state. See, initially they might have planned to spend this much, but it doesn't look that this price can be accepted in the market. So as they move forward, when they understand that this is not an acceptable thing, so they start taking measures to cut down on this cost so that the product is sold at a price derived from the market. This is a concept of target costing. So this also simple numericals are there. um, I don't think at this level you will be asked a numerical question on target costing. The same topic repeats in PM as well as APM also. That's target costing. The next topic here is product life cycle. Again, to go with the equation, selling price is derived by adding a profit margin to the cost price. But what are the costs which are considered? What costs are taken into consideration to decide what is the cost price? Usually, the operating costs which are incurred in each period, they are considered like production, administration, selling and distribution. These costs are accounted total cost plus the profit margin, then selling price is decided. But before the production work starts, see the costs which are considered are starting from the production work, production, then we see administration work, and then selling and distribution. So they start incurring the cost from manufacturing. But product life cycle, this concept says that for every product there is a life cycle. Life cycle starts from the introduction stage and goes till the decline stage. So it also mentions that even before the production work starts, before the production, before the manufacturing work is started, prior to that, there are other costs also incurred, which are research and development, designing cost. There are certain costs which are incurred before the manufacturing work starts. Then, after the product is sold, is that the end of it? No. After the sales are made also, there are costs which are incurred, which we call them as after sales service costs. These are costs which are incurred by businesses. So these costs also have to be recovered from the revenue which is generated. The product life cycle suggests that, see, there is an entire lifetime starting from the introduction stage, that is research and development, until after the product is sold and some services which are provided. What are these after sales service costs? See, once the product is sold, the customers are given some assurance that the product works well. There is a guarantee period or a warranty period. Then during that period, if there is any problem with the um, product, some free of cost services or repair and maintenance, those things will be provided to the customer. So there is an assurance given by the seller. As per their assurance, if there is any issue which is arising, the buyers approach the seller provides those services free of cost. Okay, sometimes the product only is replaced, sometimes repairs work is taken up, uh, replacement of components, various things. So for that, is the seller collecting any amount from the buyer? No, he won't be collecting any amount from the buyer. It is a service provided free of cost because that is covered under the guarantee warranty period. So the seller is obliged to take up these costs. So now the costs are not only the production, administration, selling and distribution, but there are whole lot of costs which are incurred right from the introduction stage till the decline stage. So this particular product life cycle suggests that all these costs have to be considered for calculating cost price per unit. Then the selling price should be decided, which means that first the entire life of the product, for how long this product will be accepted in the market, that has to be first estimated. The time period has to be estimated during, let's say if it is 5 years period. So during this 5 years period, all the costs which are incurred starting from research and development, product designing, production, administration, selling and distribution, even after sales service cost, they also have to be estimated. So that will be the total cost during the total life of the product. So everything is accounted. Then find out what is cost price per unit. So here it talks about starting with the introduction stage. From the introduction stage, it starts here, the introduction stage onwards, it keeps rising. When it rises, see, initially when the product is introduced, the introduction stage, before the, then later on the sales pick up. At the introduction stage, it is very less number of units are sold. But we see here, before the product is introduced into the market, even before that, there are certain research and development costs are incurred. Okay, then they start selling the product, that is in the introduction stage. Initially, very few units would be sold. Once the customers get to understand that, then the sales keep rising. Then they enter into growth phase. And then they capture the market, maximum sales happen. After a while, the product sales start declining. For some products, the product life is a very long time. For certain products, it's a very short. Mobiles and all, one particular brand. See, we see that the life is very short, sometimes 6 months. See, after 1 or 2 years, we wouldn't even get any spare part of that particular mobile. Use and throw it kind of thing. Certain old model electronic products, we do not see any such thing present in the market. Not even to the extent of a spare part is available. Some of the consumer goods are present in the market for a very, very, very long period of time. So for them, the decline comes very late. For some of the products, the decline is quite fast. So it differs from product to product. So it starts from the initial phase, starting from research and development, and goes until the decline. When the sales start falling, at that time, no more additional investment is made. Sales drop. That's it. So there is another concept for this. This is also called as cradle to grave, starting from the introduction stage till the decline stage. Cradle to grave. Okay. There is a way in which the numerical is taken up. Accumulation of all the costs. Find out the total cost during the product life cycle divided by the number of units during the product life cycle. Find out what is cost price per unit. Then decide what is the selling price per unit. Okay, so it starts in the initial introduction stage. Cost is incurred. Then this cost starts getting recovered from the sales revenue generated. Then they start earning profit. Then after a while, when it reaches the maturity point, then the sales start falling. So that's a decline. Then again they have less sales and less revenue generated, kind of a loss which is incurred. Okay. So the business should be able to survive during these two periods also. So decide a right selling price which will be able to recover these costs incurred and this losses which would be borne by the business. So decide on the appropriate selling price. The next topic is total quality management. Total quality management is adopted by manufacturing businesses. Those who are involved in manufacturing the products, conversion of raw material into finished goods. So those businesses which are into manufacturing of products, so there is an effort made by the businesses to improve their performance on a continuous basis. On a continuous basis, which we call it as TQM or total quality management. The emphasis here is to see that they provide quality products, even to the extent that there is no defective product produced. Zero defective is their objective. Okay. TQM is a continuous effort put in to improve their process. Total quality management. Total means that everyone in the value chain is involved in the process, including employees, customers, and suppliers. Quality products and services must meet the customer's requirements. So there can be no flaw, everything should be perfect, no defective, no excuse. Everything should be according to the customer's expectation requirement. Okay, then management quality is actively managed rather than controlled so that problems are prevented from occurring. So it is a continuous effort, constantly, actively managed, continuously managed. So that effort is put in so that they can meet the customer's requirement. There will be no excuse not to meet the customer's requirement. So there would be absolutely no compromise in terms of the quality which is provided to the customer. So That's the concept of what is TQM. TQM also will be studied in PM. TQM again will be repeated in APM. You may have to address one exclusive case study based on TQM in APM. So this is a theoretical concept. So the important point, the key point, what you have to remember here is TQM is a continuous effort put in to meet the customer's requirement. If to meet the customer's requirement, no defective products are allowed to be produced. So in context of that, there are certain costs which are incurred related to quality aspect. We call them as quality costs. But now at this point of time, it is not needed. So let's not discuss about that. So total quality, total quality. How can that be achieved? Is it a one-time thing that it is achieved and then it is left aside? No, it's a continuous effort put in to see that quality standards are maintained. Everybody in the organization has to put in their effort to meet that particular quality standard. A continuous effort put in to ensure the customers' requirements are met and there is no excuse for a defective product being produced. That's the concept of TQM. Get it right first time. So it says that the very first time when it is taken up, it should be the perfect. TQM considers that the costs of prevention are less than the costs of correction. One of the main aims of TQM is to achieve zero rejects and 100% quality. No defective product is allowed to be produced. So in this context, they take at every stage costs are incurred, measures are taken to ensure that quality products are produced. So prevention, before anything starts only, they have the machinery equipment designed in such a way that no defective unit is produced. Employees are provided right kind of training. Okay, so everything, every cautious effort is taken to ensure that good quality products are produced. Then it's not that it is only one time effort, but later on also as the process is carried on, then also randomly they pick out the units and verify or test or inspect them whether any defective unit is produced. So if they find that there is any defective unit, they spend some more cost on reworking on those defective units and provide the um, quality products to the customers. So that is the main point. Second aspect says that continuous improvement. The second basic principle of TQM is dissatisfaction with the status quo, which means that they do not accept the things as they are. They want that to be little better than the previous time. So a continuous effort to improvise on their way of operating, continuous improvement. Realistically, a zero defect goal may not be attainable. It does, however, provide a target to ensure that a company should never be satisfied with its present level of rejects. So, what they have done yesterday, it should be better than what they would be doing today. The management and staff should believe that it is always possible to improve next time. Then customer focus, their focus is on the customers. Quality is examined from a customer perspective and the system is aimed to at meeting customers' needs and expectations. Now we come to the next chapter, forecasting techniques. Forecasting techniques is a numerical chapter. It's a little better, I guess. Instead of listening to long theoretical topics, a numerical chapter seems to be much better. Forecasting techniques. Before, I mean, why should we learn about forecasting techniques? So what is the context of learning forecasting techniques? See, after forecasting techniques, we have budgeting. I'll give you the gist of what is budgeting, and then we'll go to forecasting techniques. What is budgeting? What is budget? Any one of you, do you have an idea about what is budget? Any one of you? I have a doubt. Is there anyone listening to my class? What is a budget? Are you awake? Anyone? Okay. Some response. Okay. Very good. 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 That's the answer basically. Budget is a financial plan. A plan which has financial aspects included in that. Okay. A plan which has financial terms. So a plan, what has to be done in future is a plan. That plan which is presented in financial aspects. So the quantitative terms are included in terms of if it is cost, what should be the cost? In terms of sales, what should be the sales? How many units would be sold? At what price would they be sold? So those are financial aspects. So we see that the term budget means it's a financial plan. So when a plan has to be prepared, see if you are preparing a plan, how do you prepare a plan? For you, if you are planning as a student, what would you have? You will see that what will you study on each day, for how many hours will you study, etc. And then you have a goal of attempting the exam and scoring best marks. So your end objective is to appear for the exam with the right amount of preparation and achieve the goal. For a business, what will be the plan? The plan will be there are many things which will be taken into consideration, but the financial aspect which is included, that is, what would be the revenue for the future, how many units will they sell, what price at which they will sell, what will be the cost to be incurred, what are the assets into which the investment has to be made, what liabilities will they have to raise. See, these are all financial aspects. A plan which includes all the financial aspects are included in a budget. So budget in simple terms, budget is a financial plan. Budget is a financial plan. So if a plan is prepared for the next period, if a plan is prepared for the next period, so what would be the various aspects, like how much should be the cost, how much would be the revenue, selling price, cost price, various types of cost, all those things. If they have to include in the plan, is it a simple task? Randomly, can they put anything? Randomly, can they write that 10,000 units will be sold next period? Is that possible? Can that be the case? See, suppose, of course, I think you have not been to the college. Maybe if you were there in the college for a few days, maybe you were there. But let's say if you are organizer of an event in a college, so then first, would you not plan on how much would be the cost of each um, item or each transaction? Will you not plan for that? So you will have a rough plan. say for stage decoration, for lighting, for sound arrangement, the chairs, the seating arrangement, the snacks. For each item, what will be the cost is what will be planned. If you were given that responsibility of arranging an event in in a college, isn't it? So there would be something which will be planned. So that plan which is there in financial aspects is a budget. A budget is a financial plan which includes incomes, expenses, assets, liabilities. For a business, if they are preparing a financial plan, there also they have to write the figures, sales how much, each type of cost how much. That has to be planned. Anything is written doesn't make sense. There should be some appropriate manner in which they plan these things. For that reason, we depend on statistical techniques, which we call it as forecasting techniques. So depend on forecasting techniques to estimate what would be these costs or these items which are included in the budget. For that reason, we need to learn forecasting techniques. See, the other day we've learned about high-low cost method. You remember? That is also one forecasting technique. High-low cost method. Um, High and low. The difference when it moved from low to high is the difference in terms of the units and in terms of the um, cost. Find out the variable component. Also find out the fixed component. You remember that? We've done in the initial one or two, first or second class, we've done one question on high-low method. That is also one forecasting technique. You remember?
Yes, ma'am.
Yeah. So now the first technique what we have here is least square regression analysis. At that time I have mentioned about a linear relationship existing between the two variables y and x. Y is a dependent variable on x. So once we know what is a and b, which are constants, and the other variable which is an independent variable, which is x. For every value of x, what is the value of y can be calculated if there is a linear relationship between these two variables. So that is a linear function. The same is the equation also used under the regression analysis. Regression analysis establishes the relationship between two variables y and x, where x happens to be the number of units and y happens to be the total cost. So using this regression analysis, we estimate what is the total cost. So y is equal to a plus bx. Y is equal to a dependent variable dependent on x. Y is dependent on x. Dependent on x. A and B are two constants. A is called as the intercept on y-axis. B is called the gradient or coefficient of x. X is an independent variable. How do we calculate A and B? The statistical equations are given. I don't know whether you have business statistics paper or this itself will take care of the business statistics part of it. So depending on this, so how do we calculate value of A, value of B? After we calculate A and B, substitute in the equation so that Y can be calculated. That is a regression analysis. We have another analysis called as correlation. If two variables are selected to establish a relationship between that, it is to test whether there exists some relationship between them. See, if two variables are selected, like cost is dependent on the number of units produced. X is the number of units. So cost is dependent on the number of units. But unconnected things, if they are selected for testing, then that would be the most inappropriate manner. First, we should understand when two variables are selected, whether there is this any relationship between them, and if there is a relationship between them, whether it is strong or weak. That also can be understood. If there is a relationship, are these variables correlated to each other? Because of change in one variable, change in the other variable is also seen or not. So when the first variable keeps changing, the impact, is it there on the second variable or not, also has to be understood. So that's measured by a variable called as R. Okay, R is given by a statistical equation here, n sigma xy minus sigma x sigma y by under root n into sigma x square minus sigma x whole square into n sigma y square minus sigma y whole square. Maybe if maybe in the next tomorrow's class we will work out one question on regression, one question on correlation. So first R has to be calculated. There are two variables x and y. If there is a relationship between these two variables x and y, when the calculated value is taken, what is the R value, and depending on R value, what type of relationship exists between these variables x and y can be understood. So there are certain values which are given. R always will lie between -1 and +1. So it must always be between -1 and +1. If R is equal to +1, there is a perfect positive correlation. So a change in one variable will result in an equivalent change in the other variable also. So there is a perfect positive correlation. If R is equal to 0, there is absolutely no relationship between these two variables. If R is -1, there is perfect negative correlation. If one is moving in one direction, the other one will move in the reverse direction. So R could be any value between -1 and +1. If it is 0, there exists no relationship between these two variables. For other values of R, the meaning is not so clear. It is generally taken as that if R is greater than 0.8, then there is strong positive correlation. If it is -1, somewhere in between we see 0, then it is +1. The R value lies between -1 and +1. So closer to 1, that is 0.8, closer to 1, there is strong positive. Otherwise, closer to -1, there is strong negative correlation. The coefficient of determination R square measures the proportion of changes in Y that can be explained by changes in X when a straight line relationship has been established. See, there are certain interpretations of what is the calculated value of R, the coefficient of determination. So there are certain um, aspects which we have to understand whether the relationship between these two is a strong relationship or not, whether it is a good fit or not. There are certain points of interpretation which is considered when we work out one question. Tomorrow's class, today it's almost time. So tomorrow's class, when we work out, we will also try to understand what's the meaning of R square. Then we see time series analysis. Another technique is time series analysis. What does it mean, time series analysis? A time period, time is the main factor. A time period is taken into consideration. The data which is there for a time period is taken, it is analyzed to understand what is the trend. See, let's say the last 5 years sales values are studied, they are analyzed. So from that, it becomes possible to infer whether sales is increasing, sales is decreasing, or there is no particular pattern about sales. There are too many fluctuations. Something can be understood when it is taken into consideration and analyzed. So we see that when time series or a time period is selected, a variable is put to test, and then it is studied, it becomes possible to establish a trend. What is the pattern? What is the structure, style and structure and trend of that particular data? Let's say it is increasing. Let's say, for example, sales is increasing. So once they understand that, it becomes possible to extend the trend into the future. For example, for example, sales is increasing like this. This is the current period. Current period, it has come till here. So now they have established a trend. The next period, if they want, next year also, they want to know what is the sales. The line would be just simply extended. For the next year, this will be the value of sales. Once the trend is known, the trend can be extended to future. When it is extended to future, it is forecasting for the future. Then, considering the seasonal variation. So, certain businesses have seasonal demand. All through the year, it would not be the same thing. So, seasonal variation, cyclical variations, or any other random variation. So, those variations or those changes are also incorporated into this data, and then using this, estimating the value for the future period. That is time series analysis. Next, we have the index numbers. Index numbers, the calculated value of index numbers, talk about what is the change in the values on account of changes in the prices. So index numbers are calculated. We have simple index numbers, we have chain-based index number, multi-item index number. All of them have numerical questions. So we have to work out because that's my numerical chapter. One second, I'll pick out one question so that we can take up one question and then work it out. There are no questions in the exam kit. Okay. I didn't find questions in the examination kit on forecasting techniques. I will once again look into that and then explain to you how do we work it out. Um, Chapter number 13. Chapter number 13 is budgeting. What is a budget? We got the answer. The financial plan. A financial plan which is prepared prior to a given period of time is called a budget. The process of preparing budgets is called as budgeting. The process of preparing budgets is called as budgeting. So this is a very lengthy topic because there are many numerical questions we have to work out. So tomorrow's class, it looks very small in terms of the content, but many types of budgets are there which have to be prepared. We have to learn. So much of focus is not there in terms of the numerical questions when it comes to PM. But the expectation from the student is that they are thorough with after this chapter, all whatever chapters are there are all very important. They would not ask you to calculate basic questions. The next level of expectation from these topics is that you are thorough with these topics so that you can um, draw insights from this data. So how are the budgets prepared? What is the procedure? Or if someone prepares the budget, you have to analyze that. So that's the expectation. So it goes on till APM, but you will not be like ABC. I said ABC will be done in PM thoroughly, but budgets will not be done thoroughly in PM because you are expected to learn budgets here in MA paper. So there would be no excuse if you don't learn here. Same is the case with variance analysis. Same is the case with performance management. Okay. So in terms of number of chapters, what we have to do, the count is less, but the content is more. So there is a serious effort which we have to put in for learning what are budgets, what are the numerical questions, how budgets are prepared. Many types of budgets are there. So each one, at least one question I'll make you through. I'll run you through the exam kit for these things. After budgets are done, then we have to do standard costing, then performance management. So performance measurement. So these things are time consuming. One topic, one full 2 hour session we have to spend. Okay. So on that note, the rest of 5 days, at least 3 days will be for three topics. Then again we have to include all the other things which we have to cover up. So time is little, we'll find it very less time. So tomorrow join. Do you have a class tomorrow? I'm sorry to ask, but I don't have a. Just tell me, do we have a
No,
class? Yeah.
we don't have class tomorrow.
So when are we having it again? Monday.
Yes, ma'am, on Monday.
Okay. Done. Okay. So we'll join on time and then we'll start very quickly so that we use all that time and then possibly be able to finish budgets in one day. One full day minimum it will require. Please join on time. Those who join, please join with your audio, video anyway. It's not on, but join with your audio. See, what's the point you join apart from getting attendance? There's no other purpose behind that. So I see someone. Do we have class tomorrow?
Yes, ma'am. We have class, ma'am.
Let me also check the calendar.
Ma'am, sorry, ma'am, we do have
Okay,
class
no
tomorrow.
problem.
On Sunday, we don't have.
When do you do not have? When is that?
On tomorrow, we have class, ma'am.
Okay, let me also just look into that and then confirm. Because I get confused and then usually tomorrow we have a class. 29th also we have a class. Yeah. Tomorrow we'll meet and then wind up this budgeting session tomorrow. Join on time and then we'll take it up. All those who join, please join with the audio part. Without audio, I'll send you to waiting room. Today I've done that with one student. If I see anyone joining just for the sake of attendance, you will not even get the attendance. I'll send you, I will remove you from the class also. Okay. Okay, then let's wind it up today. Okay, see you tomorrow. We'll do budgeting questions in tomorrow's class. Okay. Good day.
Thank you, ma'am.
Thank you,
Thank
ma'am.
you, ma'am.
Thank you, ma'am.
Thank you,
Thank
ma'am.
you.
Thank you.